Street today, moving the markets into a bear market. The Dow dropped almost 900 points today. The Nasdaq down 530 and the S&P down 3.9% today, more than 20% below its record set earlier this year. And Steve Lewitt, a financial advisor and the president of SGL Financial, is joining us now to talk about the markets today. Steve, thanks for being here. So bull market up, bear market is down here. When does that become official?
It's official. The bear market means when the market drops more than 20% from its previous high, we are in a bear market. As you said, the S&P is down over 20%. The Nasdaq, which is tech-driven, is down almost 30%. The Dow is down 16, but it's headed into bear market territory. And the bears are here.
Well, let's get to the heart of this here. Is it mostly inflation that you think is driving this? Is it a combination of that with the war in Ukraine? Talk me through that.
Yeah, so it's inflation first, second, and third. And the cause of inflation is supply chains, the war in Ukraine, and a lot of geopolitical backlogs that are taking place. But when there's inflation, the Federal Reserve wants to raise interest rates. When they raise interest rates, the market doesn't like when interest rates go up because it's bad for business. And now everybody's waiting on the federal market report on Wednesday to see if interest rates are going to take yet another big jump. Inflation is 8.6% higher than last month, twice as high as the year before, and there's no end right now in sight. So things are very problematic, but there's inflation that thrives. In addition, I might add that internationally, inflation is over 8% as well. So your international bankers are also raising interest rates. So this is not a healthy environment for the stock market.
It always seems worse when the whole world is fighting the same battle here. No one to lean on here. Bottom line here, for anybody who's got a retirement savings account or other investments here, and I want you to spend some time with this. What should people be doing with their money? What do you say to your clients in these difficult times?
Okay, the first thing is don't panic, don't react, don't go out and sell, don't try and say, well, I'm going to sell everything. When the market goes down, I'm going to go back and buy in. Timing the market doesn't work. And the second thing is to understand where you are in your goals. If you're close to retirement, you might think of de-risking your portfolio. If you're younger, well, you can afford to take losses. If you're contributing to a 401k, well, keep contributing, because then you're doing something called dollar cost averaging, which is taking advantage of the down market by buying more shares. So the idea is to think long term. The stock market, as we know, traditionally goes up long term. It might be a bumpy ride, but if you look back 20 years ago to today, the market is a lot higher today, even though it's headed downwards than it was 20 years ago.
I know, Steve, but that's what that's what we hear every single time we're heading into a recession, or if the markets are down like this, we say, just leave your money alone. You know, it depends on what your time frame is here. But as interest rates, the Fed meeting again tomorrow, going to go up again here. What should we expect there?
Yeah, so when interest rates go up, things become more expensive. Credit becomes more expensive. Interest on credit cards become more expensive. Mortgages become more expensive. So this is a time to really focus on getting your debt down, getting it, maybe paying it off. Being careful on what you spend, being careful on any variable rate that you might contract for in the future, because interest rates drive all the debt and the level of debt, and you don't want to get caught in a trap there.
Steve Lewitt with SGL Financial. Thanks for the information.
Okay, it's great.
All right, see you later.
Thank you.
Checking now with